All right, so this is a read through of Smucker's 10K. The original rendition of this video was 57 minutes long, so I'm going to cut that down because no one wants to hear me speak for an hour about anything. You're welcome. So right now, looking at a Smucker's ticker symbol SJM, they had about 114 million shares outstanding. They are incorporated and their executive offices are located in Ohio, Orrville, Ohio, to be precise, for their executive offices. Established in 1897, incorporated in 1921, they are in one industry, the manufacturing and marketing of branded food and beverage products on a worldwide basis, although the majority of our sales come from the U.S. Net sales outside the U.S., subject to foreign currency translation, represented about 6% of net sales. In 2018, they bought Ainsworth Pet Nutrition, an all-cash transaction funded by debt and valued at $1.9 billion. August 31st, 2018, they sold their baking business to Brynwood Partners, and the baking business was Pillsbury, Martha White, Hungry Jack, White Lily, Jim Dandy. They also sold the manufacturing facility in Toledo, Ohio, which generated, a one-time boost to net sales of $370 million. Four reportable segments: retail pet foods, retail coffee, retail consumer foods, and international and away from home. And the retail market segments were about 87% of net sales in 2020 and represent a major portion of their strategic focus. And international and away from home represent sales outside the U.S. retail market segments. Their principal products: coffee, dog food, cat food, pet snacks, peanut butter, fruit spreads, frozen handheld products, shortening and oils, portion control products, juices and beverages, and baking mixes and ingredients. And they sell to everywhere that can stock food. Food retailers, club stores, discount, and dollar stores, and so on. The sources and availability of their raw materials on page 2. And obviously they have a huge derivative hedging program to make sure that they can manage their costs, as I'm sure they tend to be on the large side. And they deal with green coffee, peanuts, animal protein meals, oils and fats, sweeteners, grains, fruit, and other ingredients obtained from various suppliers. And they source peanuts, animal protein meals, and oils and fats mainly from North America. Principal packaging: plastic, glass, metal cans, caps, carton board, and corrugated. Nothing too crazy there. Page 3, they're talking about their trademarks and patents. They own an incredible amount of patents, trademarks, Dunkin' and Dunkin' Donuts are owned by DDIP Holder, LLC, for packaged coffee products. Used under 2 licenses for packaged coffee products, including K-Cup pods, sold everywhere that they can be purchased. The Dunkin' licenses don't pertain to Dunkin' coffee or other products for sale in Dunkin' restaurants. And the Dunkin' licenses are in effect until 2039. They utilize Rachael Ray's image and likeness for the Rachael Ray trademarks, and they are owned by Ray Marks 2 LLC. Keurig is owned by Keurig Green Mountain, and for the Rachael Ray trademarks, they expire in 2063. I don't know how they negotiated that one now, but 2063, that is a long, long time. Slogans or designs considered to be important trademarks without limitations are, of course, a lot of their sayings. The crock jar shape, I didn't know that that was patented by them. The gingham design, whatever that is, I'm not familiar with it. The Folgers Mountain Sunrise, the Jif color banner, and the Smucker's Strawberry, Milk-Bone, and 9 Lives logos. I had no idea the crock jar shape itself was actually a patented thing for them and them alone. Seasonality: fall bake and holiday period for the retail coffee and retail consumer foods, which generally results in higher sales in their second and third quarters. Success in promoting and merchandising their coffee and baking brands during the fall bake and holiday period has typically had a significant impact on their results for a fiscal year. Back to school and spring holiday periods are also very important. But since they sold the baking business, it reduces their seasonality in the retail consumer food segment. since they bought out the Ainsworth, since they did the Ainsworth acquisition, the pet food segment doesn't experience significant seasonality throughout their fiscal year. Working capital, historically greatest during the first half of their fiscal year, mainly due to the timing of the buildup of coffee, shortening in oils and baking inventories necessary to support the fall bacon holiday period, and the additional buildup of coffee inventory in advance of the Atlantic hurricane season. Okay, so they want to beat the curve and make sure that they don't have any delays in supply chain and logistics. And since we're in the hurricane season right now, in August of 2020, they're more than likely stocking up as much as they can to make sure that they don't have any weather-based disruptions. The divestiture of the baking business and the acquisition of Ainsworth has further reduced the seasonality of their overall working capital requirements. Sales to Walmart and subsidiaries amounted to 32% of sales in 2020. These sales are primarily included in the retail market segments. No other customer exceeded 10%. During 2020. However, their top 10 customers accounted for approximately 60% of consolidated net sales. Supermarkets, warehouse clubs, and food distributors continue to consolidate, and they expect that a lot of their money will come from a limited number of customers. Generally, orders are filled within a few days. Competition, anybody and everybody that could possibly put something on a shelf is their competition. And they mentioned something very fascinating here at the bottom of page 4. Private label continues to be a competitor in many of the categories where they compete, partially due to improvements in quality and the emphasis of store brands to create customer loyalty. Private label, in their total U.S. retail categories, private label held a $16.4 average market share during the 52 weeks ended April 19th, 2020, as compared to a $16.6 average market share during the same period last year. They closely monitor the price gap or price premium between their brands and private label brands, which, with the view that value is about more than price. And the expectation that number one brands will continue to be an integral part of consumers' shopping baskets. Okay, what you got to get out of this? Private label held $16.4 average market share during their fiscal year ended April 19th, 2020. Last year it was 16.6. I don't usually end up seeing a company break out some of the more granular parts of their industry like this. So this seems pretty important to know. That I have a feeling that they don't have to mention that information. But that they did means it's very important. Page 5, their brands, their competing brands and their competitors. They compete with Nestle, Kraft, Heinz, Keurig, Dr. Pepper, various private label brands that compete with Mars, Restaurant Brands International, Hormel, Andros, Welch. I didn't know that they didn't own Welch. I actually assumed that they did. Crisco is the market leader within the shortening category. Footnote, page 5. Employees, 7,300 full-time employees, 24% of them covered by unions, and they believe their relations with their employees to be good. On page 6, family-owned company, Richard and Mark T. Smucker. Mark Smucker being an officer since 2001, Richard Smucker being there since 1974 and is the executive chairman, Mark Smucker being the president and CEO. Onto the risk factor section. This is going to be the fun stuff. COVID-19, of course. Unable to grow their market share of products. They operate in the competitive food industry whose growth potential is positively correlated to population growth. Their success depends in part on their ability to grow their brands faster than the population in general. That's pretty important to know because if you have not been paying attention to cultural trends with millennials, most millennials don't want families or they're delaying that. So if population growth becomes delayed over the long term or regresses, if anything, this company will shrink. And they have mentioned that right here that they want to grow their brands faster than the population in general. Well, if the population doesn't grow, they have a problem. You're going to have to pay attention to some cultural demographics here for a company that is this big and can only grow but so much during any given year. You're going to want to pay attention to how they understand their growth and in what ways they understand their growth to continue. This is once again on page 8. single national broker to represent a portion of their branded products to the retail grocery trade on down here. They've elected to source raw materials for Folgers, Jif peanut butter and Crisco, and K-Cup pods and Pepperoni dog snacks from single sources of supply. And Keurig is the only one that makes the K-Cups, of course. And they, if they go under, it might be a bad thing for Smuckers. Page 9, they may be limited in their ability to raise prices as private labels take away the market share that allows them to be able to raise prices. Americans compete on price and nothing else. So if they raise prices, they may lose market share because most Americans don't want to pay too much or really anything for anything. Some of their products are produced at single manufacturing sites. All of their coffee is at one manufacturing site. Milk-Bone dog snacks, fruit spreads, toppings, and syrups, all at one manufacturing site. And that manufacturing site is mentioned on page 10 in New Orleans for all their coffee production. Would not have expected Coffee Bustelo to be made in New Orleans, but that being said, they mentioned that any wildfires or tornadoes in areas where they are frequent, like Alabama, Kansas, and California, may be a disruption to their work processes. And considering they only have one site to do a lot of their stuff in, it seems pretty apt to mention that might be a risk. Changes in their relationship with significant customers, Walmart 32% of net sales, and trade receivables included amounts from Walmart were 131.9 million, 24% of total trade receivables balance. That is an incredible amount. That is very concentrated. Have an incredible amount of indebtedness. It's no surprise as they drew down for their Ainsworth acquisition. Not that they can't pay it down, they absolutely can, but they see it as a risk. Have an incredible amount of goodwill sitting on their books. The carrying values of the goodwill and intangible assets within the U.S. retail coffee segment were 75% of the total goodwill and indefinite-lived intangible assets of 2020. They recognized $465 million of impairment charges related to goodwill and indefinite-lived intangible assets acquired as part of the Big Heart Pet Brands acquisition almost 5 years ago. These are the properties. This is showing where all the factories are located. They make canned milk in Canada. No surprise. No surprise at that one for some odd reason. Suffolk, Virginia liquid coffee, and fruit in Grandview, Washington. Just to point out a few things here and there. They lease their coffee silo facility in New Orleans and their facilities in Seattle. COVID-19, page 21, they mentioned some of the things that they did to try to make sure that their employees last through the fear that happened earlier this year, or still happening really. They mentioned that they gave financial assistance to employees in the form of a $1,500 hardship award to frontline employees, up to 12 weeks of full pay and benefits continuation for employees unable to perform their roles, 14 days of sick leave, paid sick leave to individuals with and or caring for family members with COVID, and an assistance fund seeded with that's going to be $100 million to support employees significantly impacted. I'm pretty sure that's $100 million. 100% payment of COVID-19 testing through their insurance provider, reinforcement of mental health resources available to employees, and an incredible amount of charitable activity to various donations, both local and national. Now, they also mentioned here something very important. At the end of 2020, consumer demand and customer orders remain elevated compared to historical seasonal comparisons. They've also experienced a decline in products sold in the away-from-home channels as a result of COVID, which have negatively affected sales. The increase in consumer demand may partially reverse in the coming months as consumer behavior may change as a result of the length and severity of the pandemic. But they still said consumer demand and customer orders remain high compared to historical seasonal comparisons. So they're riding a wave here in terms of their sales. Page 22, they mention net sales, excluding acquisitions, divestitures, and so on, increased 1%. Volume mix contributed 2 percentage points to net sales, driven by Smucker's, Dunkin', Milk-Bone, and Meow Mix. Lower net price realization impacted net sales by 1 percentage point due to lower net pricing for coffee and peanut butter. Gross profit increased 3% in 2020 due to favorable net impact of lower prices and lower costs, favorable volume mix, and the non-comparable meaning one-time benefit of Ainsworth, partially offset by the non-comparable one-time impact related to the U.S. baking business divestiture. Interest expense decreased 9%. They source green coffee. This is on page 24 now. Switching to commodities, they source green coffee from 20 coffee-producing countries. Animal protein meals, peanuts, and oils and fats, mainly from North America. The price of peanuts, animal protein meals, and oils are driven primarily by weather, which impacts crop sizes and yield, as well as global demand, especially from large countries like China and India. And the supply chain for animal protein meals and fats has been significantly disrupted by COVID-19. This is going down their segment breakdown, segment results. Segment profit, retail pet foods increased 10% here. Then here it says, page 25, net sales decreased by 10 million, including the impact of 2 weeks of incremental Ainsworth sales in the current year. Excluding the Ainsworth business, net sales decreased, reflecting a decline related to private label products. And it was offset, the decrease was offset by gains for the Milk-Bone and Meow Mix, which is reflective of the incremental net sales from stock-up purchasing related to COVID-19. So these are kind of one-time rises that they're seeing happen. Retail coffee net sales increased 27.2 million, which increased net favorable volume mix, increased it by 5%, driven by Dunkin', Folgers, and Café Bustelo. Lower net pricing reduced net sales by 4 percentage points, reflected promotional activity across all brands. And retail consumer foods decreased by 29.8 million, driven by a 102.2 million non-comparable one-time impact of the U.S. baking business. Excluding it, it increased 4%. Volume mix contributed 7 percentage points to net sales, reflecting the benefit of incremental net sales resulting from increased consumer demand due to COVID-19. These are a lot of one-time, once-in-a-century events that they're riding because people were stocking up on familiar brands that they knew best and had some sense of contrived safety in when it came to COVID-19 and everybody's stocking up on everything. So no wonder that everybody ran to, the brands that they knew best because there's safety in that familiarity. International and away from home sales decreased 24.4 million, including a one-time impact of 3.7 million on net sales due to the divestiture of the baking business. Volume mix reduced net sales by 1 percentage point due to the decline for the Folgers brand and increased shipments in the prior year related to the closing of facilities in Mexico and transition to a distributor export model. So they're making some big changes to this segment. Liquidity. Long-term debt repayments of 900 million this past year, dividend payments of 396.8 million. I would like to see this reduced so they could just take out their debt completely, but this company seems to be able to pay off their debt very, very quickly. So wouldn't be too much of a worry, I guess. Page 27, something very fascinating. Supplier financing. Payment terms with their suppliers deemed to be commercially reasonable, generally range from 0 to 120 days. They entered into an agreement with a third-party admin, a bank, to provide an AP tracking system, accounts payable tracking system, and facilitate a supplier financing program, allowing participating suppliers the ability to monitor and voluntarily elect to sell payment obligations to a designated bank. Participating suppliers can sell one or more of their payment obligations at their sole discretion, and their rights to and obligations to suppliers are not impacted. No economic interest in them doing so, and nothing else is affected. There's no headaches if they do it. 157.5 million of outstanding payment obligations were elected and sold to a bank by participating suppliers, and they paid 31.8 million to a bank for payment obligations that were settled through the supplier financing program. This is very, very interesting stuff. Not that it's a bad thing, but it allows companies and suppliers to basically have short-term loans without the promises, without the rest of the legal contingencies that a short-term loan would require. They are involved in a legal case, CERT v. Bradbury. On page 27, they mentioned that they are being charged alongside 80 other defendants who make, distribute, and sell coffee that they fail to provide warnings for their coffee products being exposed to the chemical acrylamide as required under Proposition 65. And their argument is that acrylamide is not added to coffee, but it's in coffee in small amounts as a byproduct of the roasting process, and they have no idea how this trial is going to go. Big companies like this handle legal cases all the time. It shouldn't be too much. They break down their capital structure here. Very fascinating. Total capital, which they see as a combination of book value, shareholders' equity, total debt, long-term debt minus current portion, short-term borrowings, and a current portion of long-term debt. So short-term debt plus long-term debt, and then shareholders' equity. So debt plus equity. I'll type that in for as a shorthand in the description section. They didn't purchase any shares. On page 28, they didn't purchase any shares this year. Most recently finished fiscal year. Non-GAAP measurements. I try to ignore that. I know it could mess with the way that I see the company. Skipping down to see just the one quick thing. There we are, in all material respects. I know this is not a foolproof way to see if the company is doing anything odd with their accounting or not, but when you're like me and you don't have any other great resources to try to figure out if the company is good with their accounting or not, you have to look for the phrase in all material respects and trust the auditors. What can you do? Ernst & Young. Ernst & Young since 1955. Skip down. Revenue recognition on page 47. Transaction price is based on the list price included in their published price list. During 2020, 2019, 2018, they adjusted for promotional activities. At least 2% of both consolidated pre-tax income and cash provided by operating activities. Total promotional expenditures represented 39% of net sales in 2020. Shipping and handling costs, transportation costs were included in SD&A. Distribution costs relating to the warehousing costs incurred to store their products were $286.4 million. Advertising expenses were $198.6 million. They're spending a lot of money to do what they do, which is no surprise, quite honestly. Research and development, and their research and development costs include the depreciation and maintenance of research facilities. Found that interesting. R&D expense was $57.7 million. This is not that large, and I'm actually surprised at that. Trade receivables. They record a doubtful accounts allowance of $3 million, which is really tiny. This kind of tells me that they're not worried about their receivables not getting paid, even though $131.9 million of it rests with an incredible amount of concentrated customers. They aren't scared that they won't get paid. Page 49, inventories, FIFO, cost of finished products and work in process inventory. Work in process is included in finished products in the balance sheets and was $65.4 million. PP&E is depreciated on a straight line basis, of course. Marketable securities on page 50, $38.6 million worth of marketable securities. Equity method investments, well, I cannot speak today, excuse me. They have 20% equity interest in Mountain Country Foods and a 42% interest in Numi. Never heard of these brands personally, but that's just me. And there's more on their supplier financing program on page 50. Nothing new from what was mentioned earlier. $157.5 million of outstanding payment obligations were elected and sold to a bank by participating suppliers. The payment of these obligations is included in cash provided by operating activities in the consolidated statement of cash flows. Included in accounts payable were the $157.5 million, so you can find it lumped in the accounts payable segment. And they're breaking down segment profit here. And you can break down a segment cash flow, and the way that I calculated was I was taking segment profit as EBIT, 552.7, and I'll just crank it out right here real quick, 552.7 million. I was viewing segment profit once again as EBIT, so retail pet foods was 552.7 million plus, and I'm going to add back these things are annoying. Add back the 243.0 million minus the additions to PP&E. They break the segment CapEx down. So what you get is 735.6 million in cash flow for retail pet foods, basically EBITDA minus CapEx, which I don't like that version, but this is the best way that I can get it. So moving right along, bottom of page 55, they're breaking down the largest revenue drivers for their respective segments. Coffee is the biggest one for them in the entire company. Dog food, then dog food for retail pet foods, Retail consumer foods, peanut butter. And they kind of obscure this a little bit, the international away from home. They throw in juice and beverages in between the international and away from home segments. The international, they have other for the vast majority of their international away from home segment, and that's not really broken down into what it may be, what the other comprises of. The primary, subscript A here, the primary reportable segment generally represents 75% of total net sales for each respective category. So I'm going to assume here they mean that coffee is 75%, at least 75% of their net sales for their respective retail segment. Their debt and financing arrangements. They drew down on their term loan at $1.5 billion to finance the Ainsworth acquisition. In March of 2020, they completed another senior notes offering. All of their senior notes are unsecured and interest is paid semi-annually. They can prepay all of their senior notes at 100% of the principal amount thereof and any applicable make-whole amount. They have an unsecured revolving credit facility at $1.8 billion with a group of 11 banks that matures in September 2022. If there's another COVID hit, then they're more than likely going to draw down on it. Something I find fascinating here are their pension plan and what they're investing in. Their current policy on page 63 is to invest approximately 65% of assets in fixed income securities, remaining invested, the rest of it remaining invested in primarily equity securities. Their actual rate of return was 7.8% and 3.8% for 2020 and 2019 respectively. And they break down what each of these segments means here on page 64. They are invested in their international equity security segment here, 67.5 million of it invested in developed countries and also in emerging markets, taking a little bit of risk, in bonds. They're typically drawn in high quality issuances ranging from 10 to 13 years in duration between high quality US and foreign corporate bonds. They're also invested in a real estate fund in the Canadian markets and a common collective trust fund investing in direct commercial property funds. The real estate fund and the collective trust fund are classified as they are here. And this small category here, subscript G, $10.1 million is given to a private equity fund consisting of a limited partnership interest in corporate finance and venture capital funds, as well as private limited investment partnerships. So they're invested in a private equity fund, and they're through that corporate finance, venture cap, and probably a hedge fund. Private equity fund and private limited partnership are not redeemable, and it would require liquidation based on the underlying assets, and the fair value of these funds are based on their net asset values. And they're also helping fund a multi-employer pension plan, them and the Bakery and Confectionery Union and the Industry International Pension Fund are trying to fund a pension plan for their respective employees, and it is not doing so well. It is funded only 50.4%. And a plan in the red zone is at least less than 65%. This is not going so well for them. They're going to have to fix that, to say the very least. I think that is going to be it for me. So the next video, I'm going to do one of their competitors. I'm going to pull up Hormel. They're publicly traded. I'll do a Hormel Foods for the next video. There's a lot going on here that I do like. Quite honestly, this was one of the more fun ones to do. If you like this kind of content or have any critiques, comments, so on and so forth, please leave them in the comment section below. Please remember to like and subscribe to the channel if you want to keep seeing videos like this where I run through 10Ks in a bit of a nitty-gritty fashion. And thank you for your time, and thank you for your attention.